what are the biggest problems in this world, and we apply a lens which is similar to effective altruism, if that's a known term for you. It basically says, what are the biggest problems? What are the hurdles that is stopping these problems from being solved? Then look at the solutions for those problems, which need to be feasible, right? They need to be within reach, they need to be scalable, and they need to be underserved.
Welcome to this week's episode of Leaders on a Mission. Now, I'm your host, Simon Leach, and in today's episode, we're really going to be focusing, I suppose, on these key questions, right? So where are we headed in the world of impact investing? And how do we build businesses that solve critical societal challenges? And, look, with great pleasure, I'm joined, on the show by Helmer Schukken, a managing partner of Rubio Impact Ventures. And, on this call, during this podcast, we're going to explore the kind of emerging sectors and innovation within the climate space. And I think where we're heading as well. And Helmer's been at this for about 11 years now, so he's got loads of really interesting kind of insights to share. And Helmer, thanks so much for kind of sparing the time and coming on the show today.
It's my pleasure, Simon. Thank you for having me.
Look, great. And really interested with your background, because it looks like you prior to, the last 12 years and with Rubio, you had a really kind of varied and broad background. I know you were CEO of a startup, you were doing some consulting. What was the point for you where you really wanted to dedicate your kind of career, and where was that kind of connection with this particular space for you on a personal level?
Yeah, that's a good question. So I think the common thing in my career, I find it a difficult word because I don't think of my life as a career, but anyway, of the choices I've made is that I typically don't know what to do. Because there's just so much to do in the world. So I'm having a hard time, choosing. So as I left high school, I actually enrolled for law, medicine, and engineering. So that's a pretty broad scope. I chose engineering. I thought it would be a broader scope than the other two professions. And went into consulting, I guess, again, because I didn't know what to do. So with consulting, you get to look inside of a lot of companies. And as an engineer, it will be interesting to find out how business works. Got really fed up with making slides and having no feedback on whether your advice was good or bad, because the time you get that feedback, you're already 3 clients down the road. So there's no feedback loop, and it's a frustrating profession, to me at least. Very meaningful to learn as an engineer, but not as a profession. So moved to Indonesia just for adventure of living abroad. And there my boss told me, I think you have all the capacities to become a successful business person. The only question is, do you have the balls to go in your own? So at the age of 30, I thought that was a good challenge for me. So I decided that if you want to have your life the way you want it to be, you should become an entrepreneur, because then you get to decide what to do and what have other people do. And I think that in theory is true, particularly if things go well. If things don't go well, you end up doing everything, including the things you don't like. So it's part true. But I think if I look back, I enjoy being part of making the bigger decisions in private companies, and facilitating decision makers who have to make those. And I think, as a consultant, I was able to do that, but as an advisor, as a CEO and co-founder of 2 startups, you're obviously making the bigger decisions. But that's an intense job, right? So right from 9 to 5, you're solving other people's problems. And then I felt like at night I needed to do what my real job was, which was to think ahead and plan and all these kind of things as CEO. So that was pretty intense. So after 2 kids and 2 startups, I did nothing for a while, and then I bumped into 2 ladies. And I think it's always that serendipity that brings you to the next decision in life. And they had a 2-pager to start an impact venture capital fund. I liked those 2 pages. I liked the 2 ladies, so I joined. And And I think if I reflect on those bigger decisions, you still do that as an investor. You don't have to make slides so much anymore. You can just have a conversation or an email exchange and do 3 bullets, and things still happen. And there's less execution pressure, right? It's the entrepreneurs that do the real work. That's how I look at it. We give our input, we try to help, and then we get out of the way. That's the way I think it should be.
Yeah. No, great. Do you miss the cut and thrust of, the operating aspect of things, having done it a couple of times at a young age?
Yes, particularly in the first couple of years, whenever I thought, okay, I can solve this, I would be tempted to overstep, I think, what my role is as an investor and sometimes as a board member. Over the years, it's become less, but still, yeah, I'm excited by the whole complexity of start and scale up. So my board roles, I think, are most rewarding in the work that I do. I enjoy that most, which is closest to being operational, but still not really being executive.
Yeah, no, get it. And so that was 2014, was it, when you kind of joined the ladies and the fund? Yeah, January 2014.
Yeah, I think I met the ladies, I think, in 2013, Willemijn and Machteld. So we started preparing along that year and set up things in 2014 and really launched the first fund in 2015.
Awesome. So tell us, because I've heard lots, right, about impact venture funds and all sorts of, I suppose, different interpretations of it. So tell us a little bit about kind of Rubio and, how you incorporate that kind of impact into the fund, as it were.
Sure. So I think, to me, what an impact investor does is invests in companies that in its core activity provides a benefit for society, be it for planet or for people. And I think that's very distinctly different from, let's say, ESG investing, where you basically invest into something, whatever it is, and you try to do this as harmless as you can for the environment, for people, and as fair as you can. That's distinctly different than setting up a company with a mission to achieve societal impact, to reduce emissions, to help underserved people find a job or access to healthcare, all these kind of things. So that's the first thing. I think the second element that is super important for us, that the impact is aligned with the business. And what I mean by that is that you don't ever, as management of such a company, want to be in a dilemma of making more impact or making more money. Because if you do that, you're bound to come into some sort of conflict. Right? So you want to find a business model where creating a bigger business, making more money, actually generates more impact as well. And if you have that, you can actually just run it as a normal company, which makes life a lot easier because that's how most things operate in our capitalist world. So, and I think, what is important, that not only to have that mission and that alignment between impact and finance, if you will, but also to make sure that everybody in that value chain of money, if you will, so the entrepreneur, the fund manager like myself, and the investors behind us, are also incentivized to achieve that double mission of making money and doing good. And I think the traditional investment model is very much aligned about, the term is called carried interest. It's basically, if I would give my investors a high return, financial return, I would get a substantial bonus. And I would say 99% of all investors are incentivized like that. And what we've added is to say, if our objective is to generate impact and to generate returns, we've got to be incentivized along both of those lines. So our variable income, if you will, as a fund manager, is based on setting impact targets and reaching them, setting financial targets and reaching them as well. And we need to surpass both before we get rewarded. Got
it. Okay, awesome. So when it comes to measuring, so I looked through, you guys have, on your website, you've got access to all your impact kind of statements, which is great. How challenging is it to really set up the framework when you can really measure this? And I suppose, what does measurement look like?
Yeah, so we didn't figure out all of this up by ourselves, right? We looked at funds that have been doing this longer than we have, such as Bridges in the UK. Um, One of our cornerstone investors is the European Investment Fund, and they had a fund in fund, so they had a pool of money that invests into multiple impact funds like ourselves, and sort of we jointly developed this methodology. Um, the essence of it is that we say, we have a framework that says, well, what are the biggest problems in this world? And we apply a lens which is similar to effective altruism, if that's a known term for you. It basically says, what are the biggest problems? What are the hurdles that is stopping these problems from being solved? Then look at the solutions for those problems, which need to be feasible, right? They need to be within reach. They need to be scalable, and they need to be underserved. That's what you should be putting your money in. So that's the first framework. And then we try to find companies that fit within those solutions, and think of their theory of change. And the theory of change basically means, what are you going to do different than the current incumbent industry is doing today, right? If it's a polluting industry, how are you making it clean? If you're disadvantaging certain groups which should not be disadvantaged, how are you making them inclusive? All these kind of questions should be in there. And then from that you go, okay, so what is your mission and how do you measure whether you achieve that mission? And that becomes a KPI. And again, that KPI, that impact KPI, should effectively also be a business KPI. If it's not, you're back to square one. You don't have an aligned impact and financial business model.
Yeah.
So that's how we set our targets. So we are closed-end fund, which means at some point we sell our companies as well. We try to do that responsibly by thinking of a buyer that is able to continue the impact mission after we've exited. But anyway, at the point in exit, we try to forecast, just as you do a financial forecast, we try to forecast what the impact is until the end of our shareholdership in that company. And we set that target. And then every quarter, just as we do revenues and EBITDA and all those standard financial KPIs, we ask our companies to report on those impact KPIs as well. So that gives you a performance on impact KPIs at company level. This can be 1, 2, maybe 3 KPIs, preferably 1 to keep life simple. And then you can measure the percentage of performance set on that impact target. Then we weigh that against the amount of capital invested. And therefore, you bring it to a fund level where you can say, weighed against capital, our performance is X percentage of the targets we set. It's going to be a longer story, Simon, so bear with me. So now we've set those targets. But obviously, if we're setting our own targets, how do we know that they're right? And maybe even more importantly, how do we know they're ambitious enough, right? Otherwise, we're setting our own targets. So if you set them low, you usually make them. So you realize them. And our variable income is dependent on it. So that wouldn't be right. So we've built in a system that before we do a transaction, before we make an investment, we go to our independent impact advisory board. There's 2 professors in there, and then there's 2 industry experts in there. And they basically get to do 3 things. First of all, they need to answer, is this impact real, right? Is this theory of change substantial? Is this the right way of going? That's sort of an academic opinion. The second is that the formulas that we apply to measure those targets, they will check whether those formulas are right? Whether the source of the data is right, whether the formulas are right. And thirdly, and this is maybe the most important one, they assess whether the targets we set are actually ambitious enough. So we have an independent body saying, this is actually the right target. Then we go through our normal standard venture capital investment process, due diligence, transaction documentation, all that stuff. Then we close the deal, we make the investment, we become a shareholder, and then we need to report back to our investors to tell them what the impact targets are and start reporting to them as well. So at the end of, as we go towards the end of the fund, you see whether you have your financial returns target met, you see whether you have your impact returns targets met. And then we've said, if we make our financial return, and I realize this might be a sound recording and not only video, but anyway, if we make our financial return, but we don't make our impact return, we don't get anything. But then that money that has been made would actually go to our investors. So we've said then we would calculate as if we had made our impact return, and give that to an NGO to compensate for the impact not realized.
Right, I love it.
So it's sort of making it real, right? Nobody gets money if we don't make that impact.
Absolutely.
Right, and if we do make our impact, but we don't make our financial return, there's no money to distribute, so we get nothing. So we have to surpass both thresholds before we get rewarded.
I think it's really admirable. In fact, the whole kind of idea and kind of thesis around this, it really is. And I looked at the people that you've got on the advisory board, and I was wondering the point they played. So thank you for kind of explaining that. Has that happened when you look back over the last kind of 11, 12 years or so?
Yep.
Has this played out in a situation where the financial has been good, but you've not made impact? Has that kind of how's it practically kind of worked out, as it relates to returning money to your shareholders, as it were?
Yeah, so that's a little too early to tell. We're still invested in a lot of companies, and no funds have been closed or wrapped up yet. I think what you typically see is that the companies that we invest into try to really change the industry that they're in, right? It's not just about finding a business model and being successful as a standalone company. There's many definitions of systemic impact, but here's ours. Our definition of systemic impact is that a company finds a way of working. It could be a technology, it could be a business model that is positive for society and has the potential to change an entire industry. Meaning that all competitors would move towards this technology or business model or way of working as well, simply because it's better. And that ambition is quite large. So I think, when I said impact and financial return should be aligned, I strongly believe this is true, and I strongly believe this is feasible, but it may take a bit longer.
Yeah.
Because the ambition is just bigger than just building a company.
Yes. Yeah, absolutely. And some of these companies, I mean, how much longer? Because it is quite a long journey, this, isn't it?
Yes, it is. I think typical standard, trying to find the right term, let's say VCs typically say anywhere between 4 to 7 years we should exit this company at X multiple. I think it will take probably a bit longer. We're more in the 6 to 9 years.
Yeah.
And obviously, the longer your capital is invested, it will put a pressure on your financial IRR, right, on the internal rate of return. So that brings your percentage in return a little bit down. I think in money multiples, so the amount of times you get your money back as an investor with us, it should be similar.
Yeah.
It takes a bit longer.
Okay, no, great. And so tell us maybe a little bit about maybe some of these segments that you speak about this kind of new business model, this innovation, as it were, Yeah. So let's how do you split the world up in terms of kind of segments and areas of interest?
So how do we split the world up? That's an interesting question. So I think, at the top level, we have two teams within Rubio. One we call the people team, the other is the planet team. So I guess one is trying to save mankind and the other the planet. Tiny ambitions. So the people team, they look at the people side of impact. So it talks about access to education, inclusive jobs, well-being. Those are the topics that are really people-related impact. I lead what we call the planet team, which looks at basically 3 subsegments, which is energy transition, circular economy, and sustainable food and agriculture. So those are the main topics within the planet team. And I can dive deeper into the subsegments of those things if you'd like.
Yeah, I mean, it's. I don't think we need to dive into the particular, subsectors, but actually, I noticed that with the people, the education and the well-being, as it were. It was a really Yeah, I really enjoyed having a read through some of the kind of companies that you kind of invest in. How dissimilar or similar are these kind of business models and companies that you're investing in, as it were, across these sectors?
You mean between people and planet,
Yeah, people and planet, yeah.
So when we started out in 2015, we were one team, and whoever was interested or had relevant experience would put his hand up and run the deal, right? So we found out that there's a distinction, right? It's different businesses. Typically in energy, we don't shy away from hardware, so there's a hardware component there.
Yeah.
You've got to understand the energy regulatory and food and ag. It's like really specific industries. And on the people side, it's different. So that's why we split it up at first. But even within each of those people or planet segments, we look at a vast amount of different business models. We're not specific about B2B or B2C. We just focus on subsectors which we understand really well or have access to experts within our network that understand it really well. And those are typically topics that are personal to us, in which we are genuinely interested and which fit into that mold of making high impact and big business.
Yeah. Okay. Great. Awesome. And and maybe let's have a little look at on the planet side of things, as it were, in terms of, even if you dive into some of those areas, right? Well, what are the areas that you're most excited about when you think about kind of transition?
So if you look at the three segments, right? Energy transition, food and ag, and then circular. I think within energy, I'm most excited about sort of the midstream part of the energy supply chain. So I think we're moving towards, the wind and solar as our new energy sources, or up and coming, right? We've got more than 50% in this country now from wind and solar. We were at 25% when we started 12 years ago, right? So it's an exciting development. But that is a volatile production, right? If there's no wind or if there's no sun, it's very volatile. And on the usage side, we see an increase in electrification. And the mess that evolves out of that volatility on the production side and the constant increase in electrification on the usage side, that's what I find really interesting. So it's energy management systems, it's smart grid, but it's also all the storage elements that are a part of it. So that's one element. I think the second part within energy is, strangely enough, anything that falls under ETS, which is the CO2 certificate trade mechanism in the EU, where basically big polluters, increasingly start to pay for their emissions. And that brings in an opportunity for technologies that could not compete with fossil at start. Because there's a price for the emissions, they become very attractive. So, for instance, a company called Rift, they make industrial heat out of iron powder charged with hydrogen. So it's powder, iron powder, and you can just drive it around in an open truck, and then you can burn it. It produces over 1,000 degrees of heat, and it comes out again as rust, and you can charge it again with hydrogen. So it's like a circular hydrogen carrier, if you will. And industrial heat has enormous amounts of energy that goes into it, corresponding enormous emissions, but it's super difficult to electrify. So those are sort of examples of that. And then the third element, I think, which is overlooked, is cooling. A lot of energy goes into cooling. There's regulation that the F gases, which are super bad for the environment, will be banned. So any technological solutions there is interesting. So those are the three items within energy I'm most excited about. And then in food and agriculture, I think there's three as well. One is biopesticides and biostimulants, so effectively replacing chemical pesticides and fertilizer. Any solution that replaces high-impact foods, and with high-impact foods, I mean either really harmful for the environment or really big emissions, or a combination of the two.
Yeah, like what? Like as an example?
So like meat, we're invested in Mosa meat, which is cultivated meat. If we solve that, we solve a lot of problems in the environment and on the emissions. Dairy, but also, for instance, palm oil. We're invested into No Palm, which uses food waste to produce an oil which has the same characteristics as palm oil. And I think lastly, and this is in line with this point, this example, which is food waste upcycling, right? There's about 30% of food that just disappears because of, let's say, inefficient use. And on the last sector, circular economy, we've done a couple of investments, and I think our hard lesson has been you need to be able to be at cost parity when you're at scale with the linear model. And unfortunately, we struggle to find opportunities that have that potential. So we haven't done a lot in it. We've had some disappointments in it as well. I think it's an important element, but it seems still difficult to find promising business models into it.
Got it. And this is specifically within regards to the circular piece.
Yes, we seem to be better at innovations in energy, perhaps also driven by regulation, which is stronger on energy than it is on circular. And also in food and agriculture, there is more likelihood of achieving cost parity than we have come across with the circular. But I'd love to hear that I'm wrong.
Right. Okay.
And find opportunities in circular.
Yeah. Understand. Look, I think all three segments are really interesting. How much has the thesis changed, during, I suppose, the life of the company, as it were? Because you've really dialed into these spaces now. Has that been the case for a number of years now, or is it kind of evolving and changing on an annual basis?
I think the world changes, trends change. If you go back to the effective altruism lens, feasible, scalable, and underserved, obviously that changes over time. But maybe as an example, things that we've kind of dropped are two segments. One is water. It's just it's an important element. It's just something that I think you need a specialist fund to do that. So we've decided to step out of that. And the other one is mobility. Right? Mobility is a large source of emissions, but if you look at the amount of capital worldwide that goes into, let's say, cleaning up mobility, it's highly overspent compared to other industries. So going back to effective altruism, it's not underserved in terms of capital. So we've decided to let that segment go and leave that up to others to do. I'm not saying it's not important.
Yeah.
I'm just saying it's not something that we will do.
Yeah, I understand.
And I guess we hold the right to change our minds over time.
Yeah, well, it sounds like you've been focused on these particular segments, right?
Yep.
And the challenge is when you look across the breadth, it's sometimes to be able to kind of do everything, right? That's the challenge.
Yeah, and we're a small team. We're just 12, 13 people, so we need to also just say no, not because it's a bad idea or it's not important, but we got to do what we think we're good at.
Yes, yeah, absolutely. So on this particular fund, this fund number 2, kind of how much have you got left to deploy? How much have you deployed? How much have you got left to deploy, and over what timescales?
Yeah, sure. The total fund size is 110 million. We're about 4 years into that fund. We've done 30 investments, so 30. And we aim to do 1 or 2 more. And in parallel, we've started fundraising for our third fund. So by the time we've completed those 1 or 2 investments for Fund 2, we hope to have launched our Fund 3, which would be sometime in summer this year.
Got it. Okay.
Yeah.
Okay. And what is the market like in the, when it comes to raising a fund now?
Yeah.
And the discussions that you're having with LPs and investors compared to where you were, I suppose, in 2021, right? If it was 4 years ago. So, what are you seeing as the kind of dynamic out there at the moment, and how would you see this evolving?
Yeah, so if I look back a little bit further to 2015 when we started out, 9 out of 10 investors that we spoke to, we had to explain this concept of impact investing, aligned business models. Yes, you can make money and make impact, that the whole fiduciary duty, isn't that a trade-off? That was still a lengthy part of our fundraising discussion. I think the very good news is that today it's much less so. Right, so I'm super happy about this. There is more funds that are operating with a similar philosophy as we are, which is very good. That means the entrepreneurs that are trying to do the right thing have a choice. They have more access to capital. I'm excited about that. If you look at the time we were raising the second fund, 2020, we closed it. VC was in a good space, right? Valuations were through the roof. People were paying, what's the right word? They were paying substantial prices for companies with little track record in terms of revenues and profitability. So those were, I think, the high days for venture capital. Today, there's been quite a reset, right? We had negative interest rates. We've got not negative interest rates now. There's a shift in the public markets, and which I think has been a healthy reset. We're back to the valuations where I think it makes sense. They didn't really make sense early 20s. I hate to say it. But as such, I think, there was perhaps over-investing in venture capital when the excitement was there in the beginning, like 5 years ago. There's less excitement we sense from our investor base. So it takes a little bit more effort. But I still believe that the concept that we are pursuing resonates with a lot of the investors that we're speaking to. So we're happy to be able to continue with the third fund.
Yeah, no, got it. And does it, like when you're out there and you're trying to, there is that dynamic and that is that change. And it is more of a challenge to convince people at this point to part with their cash. Mm-hmm. Is it a question, as an investor that's looking to close, is it a question of you just need to up your pipeline of discussions, you need to work harder rather than smarter per se? Is it just like you just need to have more conversations and more discussions, or you need to be more strategic and creative where you think maybe you can find the capital from, or both?
I'm not sure whether I have the answer to that. I think, if I come back to my story about my boss in Indonesia and why I became an entrepreneur, I think it's important to stick to that, right? Why are you doing this? It is a belief in what we're doing. It is the satisfaction I get out of that work, which means, it has to happen within the framework that we as a team of partners are excited about. And that needs to resonate with the investor. If it doesn't, I'm not so comfortable changing what I'm excited about, right? Because then, I don't get to live the life that I'm excited about. And if I'm not enthusiastic about it, I don't think I will be doing my job very well. Yeah, so that's one thing. So we try to stick to what we think is the right way of doing things. Obviously, you take into account what these people that are investing into us, they look at hundreds of funds like ourselves. So we would be very ignorant if you would say whatever you're giving us as feedback is wrong. So we try to take up that feedback, which makes a lot of sense. But I think, the institutional investors particularly, they just have multiple options and they're in no rush to take a decision. So it's not so much, having to be smarter or talking to more people or talking longer. I think it's just a matter also of patience, that the process at institutional investors, there's no time pressure for them where it is for us. So that's I think is sometimes a mismatch.
Yes, yeah. The thing that I just thought about was obviously you're so used to companies and entrepreneurs pitching to you, and no doubt you've been through hundreds and thousands of those particular pitches, and it's just. Do you ever learn anything about those that stand you in better stead when it comes to you going out there kind of pitching? And,
absolutely. We've got about 2,000 companies per year that knock on our door. And I think, that's a joy talking to all these people, because these are entrepreneurs that are like the biggest optimists in the world, right? They think, I'm going to solve the world's biggest problems. I'm going to get really rich by doing so. I mean, those are really, really optimistic, positive people. And they all come up with really smart solutions. So yes, we learn a lot from those conversations in multiple ways, in where technology is going, how you can structure your companies, where you find your talent. all these kind of things obviously is a learning journey for us as well.
Yeah, no, great. Yeah, that's good. That's great to see. And what is it like when you are investing? I mean, clearly, yeah, I get you want to see the vision and the big idea, as it were. It just seems like the struggle for small entrepreneurial companies are really getting it to either a revenue stage or really getting that kind of scale, executing in a way where they're making kind of progress towards, I don't know, towards some type of growth. And I'm wondering whether, I don't know, when you look across your portfolio, right, and you look across kind of companies that have really impressed you with taking that step. Maybe, I don't know, like an example of one or two, but particularly I'm looking at how the company needs to evolve from just vision in order to really execute and make that step. Yeah. Sorry, there's 3 questions within one there you're trying to decipher. Sorry.
Were there 3? Or
maybe even 4.
Okay. But I think I understand what you're trying to get at. So what happens between sort of the PowerPoint vision and real impact generated in society and companies building?
Yes.
So I think there's, we don't do everything, right? We are seed, pre-seed, Series A investors, and then it's up to, let's say, the bigger guys and girls to take the company to the next stage. What we look for is 3 things, and those are also the 3 things that we think we can help with, that I focus most of my time on in helping build the companies. One is to get that aligned impact business model right from the start and to really measure on that. The second is team development, right? If you look at where we've made really poor decisions, it's been with founding teams that were struggling to find a way to scale themselves, to allow talent that are, people in leadership positions that were better than themselves, to allow them into the company, and to find a way to work with each other as the dynamics of the company change. The third part, I think, which is important, is that you need to constantly be fundraising until you get to your exit, which is particularly in continental Europe still something as seen as overhead to be fundraising. I think it's core business. If you're cash flow negative, fundraising is core business. So it's our job to invest in a high risk stage of the business, make sure it's de-risked to a part where you can find growth capital, Series B, Series C investors to take on the next part of that journey. So those are the 3 things that we're looking for. And I think particularly the ability of founders to see and understand, this is what I'm good at, but this is what the company needs. So I'm going to find the best, super manager to do that for me. And he or she can earn more than I do, to step away from ego and just keep the mission in mind and make sure you get the best, diverse, talented team to lead your company.
Yeah. And is that the biggest? So when you think about it, at the stage you invest, you've got some type of, generally technology risk, or you've got some type of people risk. Yep. Where were you more likely to get it wrong from your viewpoint?
I think the technology part, you can assess kind of. You can at least, I'm an engineer, right? So you can at least compare, benchmark, run spreadsheets, talk to experts, have a professor look at it, find university. So there's more sort of validation.
Yeah.
On the people part, we are doing a team assessment as part of our due diligence. I think it's the only part of the due diligence that the entrepreneurs with us actually appreciate.
Right.
That's this whole horrible. So I find that more interesting because I guess it's less tangible, and it requires continuous effort to get it right, because the dynamics of a hypergrowth company in what is required from management teams is just changing every day.
Yeah, absolutely. And it is a real challenge, hypergrowth, small organization. That they're reinventing themselves, doubling, trebling in size. There's so many more people kind of coming and joining. It's easy to lose a bit of focus, or from a cultural viewpoint, to maintain the right kind of culture. And
that's a very good point. I think that is a very important element and role of a founder, to maintain the focus on the mission, to maintain the culture, the way you want to work with each other and interact with those around you. I think I think sometimes the misconception is that you need to be CEO in order to do that. I strongly believe you don't. Right? The Americans have a great term for just, you will become president and founder. Right? It's a good title that gives you the right to intervene and talk to everyone and make sure everybody keeps working on that mission in the way that you see fit from a culture point of view. But you can hire a much more experienced CEO to run those things that you are less good at.
Yeah.
And I think that if you as a founder can place yourself in such a role and find that talent around you to do all those things that require perhaps experience or specific industry expertise, then you're onto something great.
Yeah. Okay. No, great. And what do you, I mean, it's, when you look across at maybe some of the founders, within the portfolio, what do you think of just broadly, what are some of the biggest challenges you think they really kind of face at the moment, looking at some of the companies you have?
It's hard to generalize. I guess everybody has their own challenges. I would say what we just spoke about, the understanding of what you're good at yourself and what is needed for the company, and to fill the gaps, on what is needed and what you're not good at with really, really senior people. I think the founders that are able to do that, I think, have a big chance of being successful, regardless of technology, regardless of market dynamics, those kind of things. Unfortunately, fundraising, particularly in capital intensive industries, which are on the climate side, are essential to get to net zero. Fundraising talent across the globe, I'm afraid, is an important skill. I think those are the things. I look at a lot of startups which are technologically driven, so it's they come out of universities. So usually the tech side is quite well developed, but the commercial side is, like, I can say this, right? I'm an engineer. The typical engineer says, my product is superior to competition, so it will sell itself.
Yes.
This is just not the case, right? Not the best technology wins. It can, but not always. So to get commercial power on board early stage, I think is an important element as well.
Yeah, absolutely. One of the observations I make looking at early stage companies is sometimes they can be a little bit aggressive with their commercial numbers and traction. And just they sometimes, in food and agriculture, they sometimes just underestimate adoption and how slow conservative markets are to adopt.
I think that's particularly right in food and ag. Unfortunately, we've experienced it also right in fashion. A lot of corporates who would be your customers, nobody says no to a sustainable concept, right? It's just not done politically.
Yeah.
And quite often, if you're good, you'll get a pilot. And then you get to the next pilot, and then you get to the next pilot. And all the investments to run those pilots come from your balance sheet, not from the corporates. I'm being cynical here. But it's hard to really get to big volumes with big corporates to do that. So there's a challenge there, and I think that is a commercial savviness is not just getting the customer in and interested and sign up for a small deal, it's to get them in for big deals for the longer term.
Yeah, maybe even getting them to pay up front for some of this stuff as well, right? It's just an interesting philosophy, right? Pharma. If you look at the deal structuring of innovation within pharma. And then you look at it as it relates to kind of ag and food and broader materials and industrial segments. It's something which is taking quite a long time to to come to fruition, as it were. And it's a challenge for small companies, and they need to de-risk, and finding those kind of partners, can be a challenge for sure.
Yeah, absolutely.
No, that's great. I could speak to you all day about this stuff, Helmer, but I really appreciate you coming on. It's been such an interesting kind of journey that you've been on, but also with Rubio over the last, 14 years or so, right? It's been, it's been a wonderful journey. So I really appreciate you coming on, sharing the journey and sharing your kind of perspectives on the market. So I really appreciate your time today, and wish you all the very best with the future as well.
Thank you so much, Simon. Much appreciated.
Thank you. And to all my listeners, thanks for joining in today for this week's wonderful edition. And we'll catch you on the show next time. Thanks for joining.